Good morning and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. For this edition, we're going to focus on the energy markets, how they performed in 2017, and what the outlook is for 2018. And joining me live at MarketSite is Bob Yawger. He's a Securities Analyst over at Mizuho Americas. And Bob, you've been following the energy markets and reporting on them for years. 2017 was quite an interesting year for energy, a little bit different than what we've seen over the few decades.
It was. We had a very successful OPEC situation where they took X amount of barrels off the market, and their compliance level, which they have been terrible at in the past, was very tight this time around. They also had the cooperation of Russia, and they were able to rally the market to levels not seen for the last couple of years. Now, we're not talking rip-roaring levels to the moon, more or less, but we're talking levels in WTI in a domestic barrel in the mid-50s to upper 50s, the highs, and then in Brent, which is the international benchmark, we've made it to the mid-60s. So good levels. They don't have interest in getting the market a lot higher than that, though, because that will spawn extra production from the shale producer here in the United States. So it's a fine line that OPEC has to walk on this agreement. They've done a very good job, and 2018 will be see if they are either too successful or if people start to cheat as a result of being too successful.
Do you think this $50 to $60 level is appropriate based on supply and demand fundamentals? I certainly don't think it makes sense to be at $120, but $20 doesn't seem to be appropriate either. This seems to be the sweet spot.
It is the sweet spot, in my opinion. I think that for WTI, it's a 50 bid at 55 market. For Brent, it's probably a 60 bid at 65 market, maybe 57.50 at 62.5. So we're in that level where it really kind of works for everybody. The difficulty is that if it's successful for everybody, not to overproduce, to avoid the temptation to put as many barrels out at what you think may be the best price you get for a while. There's particular concern along the lines of the Russians, who were a bit ambivalent of their commitment to the deal that was signed just a couple weeks ago. They seem to want to be released from the deal a little earlier than everybody else. There were rumors going into the meeting that they were perhaps not wanting to sign on for as long as everybody else. It ended up being a compromise that they would meet in June to look at the agreement and see how well it's going. So that's one area of concern. Of course, the U.S. shale producer is another area of concern. First of all, price alone, against $57, the shale producer is doing pretty good. Most folks can do pretty good. They're not going to hit grand slams, but they're going to hit singles consistently on that price level. So it's a good level for the shale producer, and even getting doubles out of that. They're doing all right. Another area where the shale producer does well, though, is when they hedge their production. These are levels where they use the futures market to sell contracts. So if they sell contracts ahead of time and the price, if the Russians come out and just say, we're done with this deal, we're going to produce as fast as we can, and so they say, well, if you're going to do it, we're going to do it too, and the price goes down to $30, right. Shale producer makes money because he's already hedged up. He's already sold contracts in the futures market. Prices go higher. You have a professional trader in your room who trades that, works it higher, and they'll usually end up doing pretty good there too. But they're set up good against these levels, so that's good for the hedger. It's good for the shale producer. They've got it going on pretty good from both sides of the equation.
Do you think the smaller outliers, the smaller producers, they're out of the market at this point from the last downturn?
They're doing better than
were the real small ones shaken out at that point?
Well, it's usually it's the natural. They were the first ones in. They made all this shale production type situation happen, but it's the at the end of the day, unfortunately, in the capitalist system, it's survival of the fittest, and the big guys come in, they gobble up the little guys. So there's definitely less of them. But hats off to them for giving it a whirl in the first place. They're the ones that made this happen. When the big folks realized what they were missing out on, they went in and they bought up many of these companies. They still do well. They make them an offer you can't refuse, basically. And particular interest is going to be any smaller companies that are in the Permian Basin. That's our most prolific deposit here in the United States, especially as part of the shale explosion. But yes, even some of the smaller folks that are still around, though, they still will hedge their production. They will still participate. They will still get some futures contracts under their belt so they can protect themselves in the sliding environment. Of course, that takes away from some of the profit unless you can trade through that, roll those contracts to the upside on a rallying market. But it's the prudent thing to do. It's generally speaking the most successful strategy.
So outside of Russia, what are the other major events or risk factors that you'll be looking at for 2018?
Well, I think that geopolitical risk is always going to be an issue. That would be an upside risk, of course. That would take us to the next level, which would spawn more shale production in the process. But you have several unstable situations. You have Venezuela. That's a work in progress. Trump administration has threatened the Venezuelans in many ways, shape, and form. Those could be barrels that are taken off the market. And those are barrels that really, the United States is one of the only countries that can actually refine their barrels because they're so high in sulfur content. We have refineries in the Gulf Coast that can refine that kind of crude oil. Not a lot of places in the world can refine that crude oil with that much sulfur in it. So Venezuela is certainly one area. Nigeria and Libya are always going to be wild cards. They come and go. Libyans can get up to about 1 million barrels, but then there could be some kind of pipeline problem. Someone could put a gun to a pipe that goes to a specific field and says, hey, I want to be paid for the crude oil to run through that pipe. And what are you going to do at that point? So that happens quite often. Those risks will never go away.
But they always exist.
They always exist,
right.
Yes. So there's those. There are always new ones. There's always going to be the Iranian issue from multiple different levels, from a actual firing at each other level to a sanctions level. We could the Trump administration has threatened to impose sanctions on Iran, and if that happens, that's a problem. It's easy to say to yourself, all right, well, the United States imposes sanctions on them, that's fine, but everybody else can still do business. That's not necessarily true, because we can impose sanctions on companies that do business with them, and our business is so far-ranging and powerful that it's an issue. People will back away from Iran if that's the case. So that's always going to be an issue. There's also the Saudi versus Iran, Shia versus Sunni issue also. That's always going to be a big issue too, and it could always escalate at any given day. Or already in a fighting war in Yemen, for example, already, and in Syria for that matter, amongst other places. So it's already a proxy shooting war in other locations. If it became actually direct, it would be, you can only imagine what that would do to the price of crude oil. And
that's what's so interesting about following the energy space, because it's such a macro space.
It really is. I mean, you had a situation for years, though, where you had Iran and Iraq. They fought for a long time and knocked out each other's oil facilities to a large degree. But when it came time for an OPEC meeting, they could sit down across from each other and come to an agreement and sit down as if they were best buddies. So it is interesting, and it's really interesting how it works.
All right. Well, thank you very much for joining us at MarketSite. And traders, as always, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.